This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Investment Perspectives. Listed equity markets continue to push higher, with the S&P 500 and the ASX hitting all-time highs this month. Earnings season has been reasonable in the US and in many ways reassuring to investors given the potential impact from tariffs. However, stock prices have outpaced earnings growth, leaving many commentators calling the market expensive. Today, we'll look deeper into the current state of public equity markets and compare them to the ever-growing private markets. And to provide the insights, of course, is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
Tracey, we've had some good feedback on the podcast you did with Lane McDonald, the CIO at our US partner firm, SCS Financial. The whole issue of public versus private markets, it's something that's grabbed the attention of clients. Why is that, do you think?
Well, I think because clients can see how both public and private markets are changing for themselves right before their eyes. They see on the news how giant technology companies are becoming even bigger. So, things like Nvidia, Apple, Microsoft, Google, these companies are not only big, they've got plans to get even bigger. Meta, the owner of Facebook, is planning to build a data center the size of Manhattan. So this is so large, it would require 1.3 million NVIDIA processors to power it. So if you think one processor from NVIDIA costs around $30,000 per processor, so 1.3 million of them equates to around $40 billion in revenue for NVIDIA. So Meta get bigger, but NVIDIA get bigger. Now, NVIDIA's entire data center revenue last year was $47.5 billion. So in one fell swoop, they could double that. It is interesting that these big companies are getting even bigger, and that goes to the growing concentration of the public market. Publicly listed equity markets where these companies reside are becoming more concentrated. There are 500 companies in the S&P 500 index. Their weight, each company's weight in that index is based on their market valuation, so their size. The 5 largest tech companies that we've just spoken about, they make up nearly 30% of that index. So from a client's perspective, that raises a very important question. Am I truly diversified when I invest in a broad market index? And the answer is not really, if the performance of that index hinges on a handful of tech stocks. But I think on the other hand, clients also hear about the advances being made by private companies like SpaceX, who we know from Elon Musk. SpaceX is democratizing access to space by making rockets reusable and satellites smaller and cheaper to launch. So this means that now, not only governments, but also companies, universities, and private startups can deploy satellites. These satellites will ultimately have multiple uses in defense, communication, Earth imaging, environmental monitoring, and many other uses. And I think probably another example, Ed, one that's very recent for us, is Moderna's COVID-19 vaccine, which most people are now very familiar with. But what's less well known is that the vaccine was built on mRNA technology that Moderna had been developing for years as a private biotech startup. So, to butcher Hemingway's quote, Ed, innovation happens quietly in private markets, then loudly in public markets.
And Tracey, this goes to the long-term thinking by private companies, doesn't it? And the patience private companies are given by their investors.
Exactly right. Private companies often have the space to think in terms of decades, while public companies are constrained by quarterly earnings calls. The difference is stark. The average holding period for a private investment is around 7 years, compared to just 7 months for a public company. That time horizon matters. With 7 years, management can invest in innovation, they can restructure a business, or they can enter new markets without being second-guessed every few months by some smart analyst. They can pursue strategies that may take years to pay off. Public companies, by contrast, are under constant pressure to meet or beat short-term expectations. And that can lead to more conservative decision-making or even, financial engineering rather than bold long-term bets. This patience in private markets is part of why many innovative companies are choosing to stay private for longer. It gives them the freedom to focus on building rather than reporting, if you like. But because the average investor holds a stock for just 7 months, volatility in the public market can be very high.
Tracey, you don't see this same level of volatility in private markets?
Well, no, because private companies can't be bought and sold easily. The very nature of private markets means they must be held long term, and this therefore makes the market less volatile. An interesting observation is that companies are staying private for longer. They don't want the volatility and short-termism that comes with public markets. And so the median age of a company before it goes public has doubled in the past 25 years. It was 6 years and it's now 12 years old. So it's 12 years old before it goes public. A consequence of this is that private companies are getting bigger. Much of the value of the company has already been made while it was private. So the value is being made in the private market, not inside the public market. And an interesting and good example here, Ed, is if we look at Spotify, it was a private company for 12 years before it listed. By that stage, it had a valuation of $20 billion. That would have been a 100% annual return every year for that 12 years if an investor held the company from its startup valuation. So by staying private for longer, private companies are becoming more valuable. And that's why we see private markets as an important part of a portfolio.
Tracy, I suppose one of the other big trends clients are seeing is the rise of exchange-traded funds, or ETFs for short. How is that impacting the market?
Yes, this is a big trend. The rise in the popularity of ETFs, and so an ETF is a basket of pre-selected companies that you buy as a group in one purchase. So what that does is it separates you, the investor, from the investment in the underlying company. So some ETFs have thousands of companies in them. You're not going to analyze each one for how attractively valued it is. If you just want exposure to the US equity market, then the ETF is a cheap and easy way to do that. But this creates a situation where price momentum in a stock is divorced from traditional valuation signals such as its earnings growth. So the price of NVIDIA, for example, can rise for no other reason than it is an 8% weight of an ETF basket that is being bought. So this makes traditional stock picking, buying and selling stocks on the basis of their underlying fundamentals, much harder. They might judge NVIDIA as being too expensive and sell it. But if investors pour money into ETFs holding NVIDIA, ETF managers are forced to buy NVIDIA shares in proportion to its weight in the ETF, regardless of how expensive it may seem. And that would be pushing the price up even further.
I guess the situation is made so much worse with ETFs now making up more than 50% of the entire US equity market.
These are big, lumpy passive flows, and they're now dominating price setting in a way they didn't 2 decades ago when ETFs made up less than 10% of the market. fundamental stock pickers buying and selling on fundamentals back then had more influence on price. Good companies were rewarded, bad companies were punished. Now, much of the buying is mechanical. If money flows into an ETF, the underlying holdings are bought in fixed proportions. No analysis, no judgment, just matching the index. You know, they will buy Tesla if it's in the index. They sell it if it leaves the index. This can inflate the price of some of the largest index constituents disproportionately. So this is why we're seeing the big tech stocks becoming even bigger. So it does tend to create a market that can look overvalued. If we think a local example here, Ed, is CBA. We've been talking about this in our meetings with clients quite a lot. Everyone has been scratching their heads lately about why the CBA share price keeps rising. Its share price was rising disproportionately to its underlying earnings. Now, one explanation could be its 11% weight in the ASX index. The Australian equity market, we talk about the US equity market being concentrated. The Australian equity market is one of the most concentrated in the world. And therefore, it's one of the hardest to be a fundamental stock picker in. And I think there is this feedback loop that's not often discussed, but the more ETFs grow, the more this feedback loop strengthens. Investors pour money into ETFs for low fees and diversification. ETFs buy more of the biggest stocks because they're weighted by market cap. These stocks rise in price, increasing their weight in the index. Future ETF inflows buy even more of them. And the job of active stock pickers becomes harder, and so they lose market share to passive ETFs and so on. So it's why NVIDIA, already massive, can keep climbing. I think even if some investors think that it's overpriced, passive flows don't care about expensive versus cheap at the stock level. Traditional stock pickers in the public market are finding their job is getting tougher. Not impossible, but tougher.
So do you think this goes some way to explaining why the market looks so expensive?
I do, yes. We look at the valuation of the US equity market using a common metric, the price to earnings ratio. Currently, it's about 21.8 times. When you exclude the big tech companies, the valuation comes down to 19.7 times. That group of big tech companies themselves is trading on a very expensive valuation of 28.3 times.
Does this then mean, by comparison, the private equity market is cheaper, since it doesn't suffer the same afflictions as the public market in terms of concentration and passive ETF flows?
The private equity market is generally regarded as offering more value than public markets. And this is driven, as you say, Ed, by the nature of the market. It's not as liquid or accessible as the public equity market, and so it tends to move slower. Private equity, we often say, is where patient capital resides. This patience affords private companies time to let their ideas develop. OpenAI, the company behind ChatGPT, is a private company. You can't buy shares in it in the same way as you can Apple, for example. It took OpenAI 7 years to bring ChatGPT to the market. Investors get rewarded for this patience with higher long-term returns. We should note too that unlike public markets, most of the increase in value in private markets comes from grassroots improvements at the company level, not from mere momentum in the market. We spoke about Tesla. Tesla operated as a private company through its early development before its listing as a public company 7 years later. It's doubtful in today's market that investors would be as patient as what they were back then. Tesla's earlier investors were willing to tolerate years of losses, production setbacks, and cash burn while Tesla developed and scaled its technology.
Tracey, you mentioned earlier that public markets are becoming more private and private markets are staying private. Some would argue that private markets are becoming more liquid with the rise of evergreen private funds. It's funds that don't lock up investors' capital away for 7+ years. What do you think of this trend?
Yeah, well, I can understand why investors like the idea of being able to access their capital more easily in a private markets fund. But I don't think it's necessarily healthy for the market. Part of the reason private markets offer higher returns is because investors accept some degree of illiquidity. If you remove that, you also remove the return premium. Greater liquidity tends to bring more short-term thinking. We've seen this in public markets. Shortening the investment holding period means investors are less patient. That in turn influences company management teams, pushing them toward shorter-term decisions and potentially stifling innovation. Elon Musk is noted for saying that being privately owned in their early years allowed them to concentrate on their mission without constant pressure for immediate results. I also value that investors currently have a choice between liquid public markets and less liquid private markets. Making private markets more liquid blurs that distinction, and in a way, it takes that choice away.
So, Tracey, where do you think we will be in 5 to 10 years, given these trends in the structure of the market?
Well, one of the things that is interesting is that only a small percentage, around 6.5% of global assets are invested in private markets right now, just 6.5%. This is despite the fact that 85% of companies with 100 million or more in revenue are private. So the first thing to say is I think there is a very big runway for investors into private markets. Private markets are heavily underpenetrated by investors. Despite this, private markets are responsible for an outsized share of innovation and growth, particularly over the last decade. I think we'll see the lines between public and private markets continue to blur. Public markets are already shrinking in terms of the number of listed companies, and many firms are choosing to stay private longer. Private markets will probably become larger. They'll become more professionalized and more widely accessed, especially through vehicles like the evergreen funds and semi-liquid structures. But the trade-off is that the traditional return premium may erode as liquidity increases. You don't get something for nothing. For companies, this could mean less pressure to go public early, but more pressure from private investors to deliver returns in shorter time periods. And I think that is something worth watching closely. Innovation happens when capital is patient. If you start unlocking these funds and opening up liquidity, the risk is that capital will become less patient. And that shift could have consequences for innovation and long-term strategic decision-making. But overall, I think we'll end up in a hybrid world, Ed, with fewer traditional IPOs, more capital raised and recycled privately, and public markets functioning increasingly as an exit route rather than a growth stage.
So for investors, that means the question won't just be public or private, but how to balance both in a portfolio that's built for the long term. Thanks, Tracey. That's all we have time for today. I hope everyone enjoyed the update, and we look forward to you joining us for the next podcast. Till then, please take care and stay safe. Thank you.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorized representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.